What separates a good VC from great ones? How they make the decisions?
I would say that what really separates great VC is consistency, which means that they don't rely just on luck. Luck has an important component, of course, in venture investments. But having luck again and again is a great skill. And to develop this skill, you need to have consistency, and consistency requires processes. So great VCs have a specific process that they follow and that they honed with their teams. So that's, I think, very, very important. Very important. Meaning that if you just make an individual investment decisions here and there, some of them are maybe going to be successful, especially if you were lucky early on. But unless you have a process, you're very unlikely to succeed in the long run. But if you have a process of, for example, how you make decisions in a group, how you network, how you identify great founders or great ideas, how do you develop your thesis, how do you follow on investments, then you can achieve greatness with time. Remember that VCs is not about one investment, it's about many investments. They have portfolio. And it's enough to have a couple of amazing companies in your portfolio. And then really nothing else matters, because those 2 or 3 companies are going to be your fund returners, each one of them.
You mentioned in the book the fast lane approach to quickly filter the deals. What are some key red flags for venture capitalists look for reject the deals very quickly? What is the trick?
Yeah, fast lane is what really all smart VCs use. And first of all, let me mention, Burak, is that the reason they use fast lane is because they network so hard, they outsource so much, they look for deals so much that in fact they're fielding thousands and thousands of deals. And then they need to come up with just a small number of those deals to invest in. I show in my research that it's 100 to 1. You analyze 100 deals, you invest only in one. Okay. And you can't analyze 100 deals, hundreds of hours each. So therefore, there's a fast lane. And yes, a fast lane meaning you identify some red flags. And the moment you meet a founder or a startup and some red flags are raised, you just pass on. You just move on to another deal. So what are the critical red flags, especially for early stage investors? First is the team. The founder, the co-founders, and the early team is the single most important factor for VCs to decide on whether to pass on the investment or whether to explore further and then potentially to make an investment decision. Now, what do they look into the team? What are the red flags? Now, sometimes it's untrustworthiness. So, for example, if the founder mentioned that they have already a great customer and a quick reference call that might take 5 minutes yielded that, well, actually, this customer hasn't paid a penny, or even worse, has never heard about the founder. That's the end of the road. Other red flags is, why you? So if you were to come to me and say, I have this great idea, and I'd like you to give me $5 million. So why you? What is your unfair advantage? Or as VCs call it, founder to product or founder to market fit. And founders very quickly need to showcase this, or VCs will say, well, we'll move on even if idea is great. So those are some of the red flag related to teams. Now, the second red flag, I would say, for early stage VCs is about the market size. Now, in some cases, there's no really market to speak of, okay, because market doesn't yet exist. So then VCs will have to use some other red flags. But often enough, the market is there, market is growing, maybe, and you can define a market. Let's say in biotech, very often the market is pretty well defined. And if the market for some kind of innovation of whatever founder is doing is small in the best case scenario, then the VCs will not be interested. They're not really interested in niche businesses. An important point here, caveat, is that obviously VCs are of different stripes. Some VCs are managing large funds, maybe 1 billion plus. Other VCs managing small funds, maybe 50 million and less. And obviously, the smaller the fund you're managing, the lower the required target market size is. So if you're a $1 billion fund and you invest in a niche market, you're very unlikely, even if the startup is going to be truly successful, you're extremely unlikely to make this startup your fund returner. But if it's a $50 million fund and maybe it's a relatively niche market, you still can be successful. By the way, it's important for founders. Founders, if you raise money from a VC, first of all, find out whether the fund that VC is investing from is a relatively small fund, is a relatively large fund. Find out what they think about the market size. So that is the second red flag.
What is the difference between asking why not to invest and why we invest in this opportunity? What are the different answers for these both questions?
That is a great question. And that, in fact, the single most important difference between fast lane and slow lane. In the slow lane, which is a typical due diligence, we're asking ourselves, why are we excited about this deal? Why we should invest? And therefore, we're answering a lot of questions along this line. In the fast lane, we're asking a question why we should not invest, and even more importantly, why we should not even proceed exploring this opportunity even further. And it seems like a minor addition of a three-letter word, not, N-O-T. But it turns out, and there's been a lot of research by psychologists outside the venture space and even outside the finance space, that just by asking question differently completely changes the perspective. So, for example, if I'm going to ask you, Burak, to go out and find out why we should not invest in this project, the type of information that you are going to search is going to be different. You're going to be more negatively biased. You are going to pay more weight on negative information. You are going to be less optimistic. By the way, it's not always a good idea to be less optimistic, more pessimistic. But in this fast lane, that's typically is more efficient. So as a result of this, and that's important to know both for investors and for founders, that in the fast lane, which is typically when VCs approach this startup for the first time, before really they introduce the startup founders to their partners, they're using fast lane. And as a result of this, they're really trying to avoid spending more time with the founders. By the way, the founders, if a venture capitalist tells you, I would like you to meet with my partners, that really means that you're transitioning from the fast lane to the slow lane. Why is it the case? Because VCs have a lot at stake in the relationship with their partners, their time, their reputation, of course, the money. And as a result of that, it's kind of a big threshold for VCs to tell their partners, well, you know what, here's a startup founder. I spent 5 hours with him or whatever. Maybe my associate did this preliminary investment memo, but I would like all you to look at the investment memo. I would like all you to meet the team. So that means that they're going to likely spend more time on you. So founders, be aware, be cognizant of the fact that the transitioning from the fast lane to the slow lane also means changing the way your startup is going to be due diligence.
Thank you very much, Ilya, for joining me today. Why is it important for the founders to think like they have a venture mindset? Also, is this book for founders or investors?
Burak, first of all, thank you for inviting me. It's great to be here. Now, the book is for really everybody who is making decisions, especially decisions under the environment of unpredictability, high uncertainty, high growth. And of course, the moment we think about startups and founders, that is their natural habitat, high unpredictability, high uncertainty. Now, at Stanford, I've been teaching thousands of students, and many of them went on to become founders. And the very first thing that I tell my students who would like to become founders is that they need to learn to think like investors. Because investors are going to evaluate them. So therefore, if they're unable to think like investors, they're much less likely to raise money. And in fact, I even prepared a 100-question list for them that investors tend to ask when they evaluate startups. And founders truly should go through that list and try to answer every single question to identify what they know, what they don't know, how they're going to react. So therefore, having the investor mindset really helps the founders. But that goes beyond that. Because as the principles of the venture mindset show very clearly, many specific ideas or many specific actions that the founders can take will increase the probability that they're going to be successful. For example, let's say when founders make decisions in their startup with co-founders, with their management team, using the venture mindset to make those decisions increase the efficiency of those decisions. Or try to think about how to select within different projects or what kind of customer to drop, what kind of customer to target. The venture mindset is really helpful.
So, your background is in finance. What sparked your interest in venture capital?
When I came to Stanford as a professor of finance 20 years ago, I started teaching basic corporate finance to our MBA students. And some of our students went on to become investment bankers, chief finance officers. And when I was observing them, they were following the principles that I taught them. And then some other students became venture capitalists. And then they kind of violated most of the principles I taught them. And I thought, why that's the case? And at the time, not much was known about how venture capitalists make decisions. So I was intrigued. And of course, my initial thought was, well, they're kind of, first of all, violating finance principles. And second is, well, let's put them right. So I started exploring and investigating. What I really realized is, first, they in fact don't really violate finance principles. It's just that they adjusted them in a specific way in the environment that they're facing in order to survive and succeed. And second, what I've learned over the years is that the way they make decisions can be used by others, including in a more traditional investment environment, and definitely by founders, and definitely by people in the traditional industries. Whenever their industry or their startup is undergoing some kind of upheavals.
How does the investment committees work, and why the conviction beats consensus on investment committees?
That is a great question. And I've been spending a lot of time with the venture capitalists now, and in fact, even private equity investors around the world. Because on the one hand, almost 50% of VC partnerships follow the unanimity or consensus, meaning that we all have to be enthusiastic enough to make an investment. And yet, my research shows that those consensus-driven investment committees are less successful when it comes to the VC deals, but more generically in the environment of uncertainty, of high uncertainty and unpredictability. And as a result of this, many VCs, including many large VCs, reached out to me and asked me, Ilya, can you come to us and just explain this? Can we have a strategic discussion, strategic offsite session about what you've seen in terms of best practices, about how best venture capital firms make decisions? And it's a long conversation. I can spend easily 5 hours, and I spent five plus hours talking about this. As a result of this, many global VC firms changed their process of making decisions. But in a nutshell, the challenge with consensus is that if everybody at the table think that it's a great idea, so everybody is absolutely convinced, it's likely indicative of two possibilities. One is that maybe, in fact, there are people who do not agree, but they prefer to be silent. And it's called conformism. And we see a lot of conformisms in group decision-making. The second possibility is that if everybody is excited, that means, in fact, maybe we're too late. Okay? So maybe this opportunity is already not that revolutionary. Now, vice versa, let's imagine that I bring to you some crazy ideas. And the best ideas typically are crazy. So, for example, Reid Hoffman, about 15 years ago, brought to his partners in a fund called Greylock an idea that at the time sounded crazy, where you can allow strangers to sleep on the sofa bed in your lounge, in your dining room, and they will pay you for it. And all his partners said, this is absolutely nuts. And yet they allowed him to proceed. So in fact, that was a conviction of one partner that was allowed to beat, that's important, was allowed to beat the consensus of everybody else. and then turned out to be Airbnb investment, which obviously was pretty successful for Greylock. But noted that many other firms passed Airbnb. And I think that if you look at most of the deals that result in 1 billion plus outcomes, or maybe even 10 billion plus outcomes these days, I think most of them at the starting point, they're controversial. So it would be easy to find a detractor, a reasonable detractor, somebody who would say, no, we should not invest because it does not make sense. That's another example, Zoom. When Zoom was trying to raise its first round of funding, it went around and many VC firms turned Zoom down. And why? It made sense. So Zoom didn't have really customers. The market was saturated with existing players, WebEx, Skype, BlueJeans, and so on. And to realize that Zoom was offering a much, much better proposition in terms of mobile experience or cross-platform experience, that actually took not just courage and not just technical sophistication, but a leap into the future, which of course was unpredictable. And even in the case where some funds, such as Qualcomm Ventures, invested in Zoom, most of the investment committee was against. And again, the most important point looking back at those is not to say, well, that investment committee people were stupid. Absolutely not. In fact, it made sense to be against. It's about how you structure your group decision-making processes. So, Burak, here is my suggestion to every single VC who is listening to us if you make decisions on a partnership, but also for every founder, if you make decisions with co-founders or a team, step back. Because many people, I realize, never ask themselves this question. Step back and ask yourself, how do we make decisions in a partnership? And by the way, it turns out that making a decision on an initial investment, so whether we will make an investment in this project for the first time, is different from follow-on decisions. Okay? There's a lot of complications, but just asking the questions, trying to understand it better, I think, will pay back.
From your experience, are these decisions intuition-based or data-based?
That's a great question, Burak. I think intuition plays an important role. Now, some years ago, my colleagues and I did a survey of almost 1,000 VCs, actually more than 1,000 VCs, almost 8,000 venture firms. And half of the people said, well, gut investment decisions play an important role. And based on this, you can say, well, just all about intuition. But I think a deep dive into this showed that it's important to ask yourself, what is this intuition based on? And the intuition is based on pattern recognition. That's important. So here is another example that I really like. Samir Gandhi, who was a venture capitalist, and at the time he was a partner in Sequoia. And Sequoia back in 2007, 2008 thought that file sharing would become big. Okay, by the way, many people thought so. And Samir Gandhi and others at Sequoia went around and looked at many file sharing startups. So it was 2007, 2008, iPhone was just released. File sharing was not yet possible. Our listeners still might remember those USB drives or diskettes or whatever. But everybody was talking about it. And Samir looked at, like 50 startups, and he did not invest in any. And one of the reasons was that he was looking for some kind of pattern recognition. He was looking for what he can learn from those founders, how well they understood the entire process of file sharing. And then he met two founders who he decided to bring those founders to his partners in like half an hour. And you might say, wow, that's intuition. But the reality is it's not really intuition. It's intuition that is based on all those accumulated pattern recognition that he accumulated over at least 50 plus meetings and thinking about this again and again and again. And those two founders turn out to be the founders of Dropbox, which is, of course, one of the most successful file sharing companies out there. As a result of this, I do believe in intuition, but I think that we overemphasize often the intuition based on the gut feeling when you're unprepared. I think that, in fact, the job of venture capitalist is not very glamorous. Many people think it's a very glamorous job. It's in fact a lot of work, And it's a lot of work to develop your intuition so that when you see an interesting deal, you recognize right away there's something interesting in there. Now, going back to Burak, to your previous question, I do believe that when you deal with the one specific investment, again, there is intuition, which is based on your experience. But when you think about the structure of your fund or your firm, when you think about the economics, culture of your firm, when you think about decision making, as we discussed, when you think about your portfolio allocation, I actually think that it should be based on a lot of fundamentals. There's much less intuition, I think, should be involved there. And again, I think smart VCs are very thoughtful about how they approach all these questions. They don't make most fund level or firm level decisions ad hoc.
Do you think that this pattern recognition should be better done with the artificial intelligence, especially having lots of points to get? Do you think that artificial intelligence, or let's say these new trends, will change the VC industry?
Yeah. Everybody's talking, of course, about AI, and I think AI is going to make inroads and will change the business model to some extent. But there's going to be a trade-off for us. On the one hand, absolutely, AI will help venture capitalists and really all the other investors. First of all, AI will help to identify patterns that are very difficult to recognize otherwise. AI will help to quantify and to find deals and founders that otherwise would be more difficult to identify. So that will improve the deal selection and the due diligence of VCs. On the other hand, I think AI is a great leveling field equipment because prior to AI development, I think that there was a big gap between those VCs that had access and those VCs that didn't have access, or those VCs that somehow accumulated great data sets or great pattern recognition. And I think that with AI, I'm not saying that it will be easy. In fact, it could be very difficult to use AI efficiently, effectively. But I think that it will be possible to enter the venture market successfully without those predetermined advantages that some VCs had. As a result of this, I think that on the other side of the trade-off, the competition in the venture market will increase.
With your also unicorn research, if we give the unicorn research to the AI, will it be also getting the patterns of unicorns?
Absolutely. So we're already seeing this. If I just give everything that we've done on our unicorn project to very simple, off-the-shelf AI algorithms these days, the AI algorithm can quickly identify patterns that we identified, maybe not as deeply so far at this point as we have identified, but right away it sometimes identifies patterns that we haven't right away seen. As a result of this, I think again the AI has a lot of future. The question is how we're going to use AI in a specific way.
How does the venture mindset approach to failure differ from the traditional business thinking, and why it is important? Additionally, failure has different meaning in different cultures.
Well, first of all, I think if you're in early stage VC and you do not embrace failure, it's much less likely you're going to succeed. I've been working a lot with large corporations around the world and their corporate venture units. And as you correctly pointed out, especially outside the US, attitude towards failure, towards losses, is typically very negative. And you are much less likely to succeed. It's, in fact, very often I tell my corporate friends and clients, it's better not to start corporate venture unit, especially early stage one, unless you're prepared that, there will be losses, especially early on in the life of that corporate venture unit. So as a result of this, unless you embrace failure, it's very unlikely you'll get home runs. You'll get those amazing fund returns. Now, you're correctly, Parag, saying that I think failure has a huge cultural aspect to this. And I think many cultures not just have different attitude towards failure, they define failure differently, but there are psychological and sociological attitudes towards failure which are different. For example, failure can equate with subsequent shame. Or in some countries, in fact, people who fail, they cannot again assume some leadership positions in companies, let's say become chairman, board members, and so on. And now for every individual founder or for every single VC, of course, it's difficult to go against that. However, especially for venture capitalists, remember, conviction beats consensus. So if, let's say you're in a culture that looks down on failure, well, as a venture capitalist, in fact, maybe you can use it to your advantage and you can invest in founders that failed. Because founders that failed, they've learned a lot. It's like one famous CEO told his executive vice president that just lost $500 million and was called to the CEO's office. And of course, he was expected to be fired, right? What do you get as a bonus? If you just lost $500 million for a company, well, you'll get fired. And the CEO said, no, I'm not going to fire you because I just spent $500 million on your education. So you better perform better. As a VC, I think it's a good trick. And also because, if other investors are not interested, you are likely to get a better deal as well. I think some research showed that those serial entrepreneurs who are less successful in the past, they're more successful in the future, conditional raising money, maybe because they are hungry, maybe because they learned from their mistakes. So again, even in the cultures that look down on failure, I think there's in fact more possibilities. There's more opportunities for VCs to make effective investment decisions.
Can you explain the home runs matter strikeouts don't principle? How does it apply to different industries? What is the power law is connected with this principle?
Of course. Well, first of all, let's look at statistics. If you look at early stage VC statistics, we will find that up to 3/4 of early stage startups fail, which means that as an investor, you invest $1 and in 3 out of 4 companies, you will return less than $1. Okay, not a very good outcome. And if you were a commercial loan officer, you would have been fired a long time ago, okay, if that was your outcome. And correctly so, by the way, you would have been fired. But as a VC, this is just kind of more or less a necessity. Now, then there will be some deals where you'll invest $1 and you'll get back $2, $3, which is great, but maybe not as great because you lost so much money. And then statistically, there's going to be 1 out of 20 deals that is a home run, which means that you invest $1 and it can get X, 100X. And if you happen to invest in Zoom, it's going to be maybe 1,000 or 500X early on, okay? So as a result of that, 1 out of 20 deals, if positioned correctly, can easily overwhelm all the losses and all the mediocre gains that you're making. So as a result of this, VCs who are, especially early stage VCs who are kind of following this paradigm, they understand that what they really need to do is to increase the chances they hit that home run, that they have access to that home run, they will be able to identify the potential home run, they will be able to invest, and they will be able, if needed, to follow on. I can invest again. And so that is the entire kind of business model, I think, of early stage VCs, whether they are able to identify home runs. Now, power law, Barak. So power law effectively says that your best investment in any fund is going to provide you higher return than all the other investments in that fund combined. Okay? So that's the power law. And as a result of this, it is the winner takes all. Or I like telling my students, it's the land of the best and the rest. And only the best really matter. Now, by the way, the rest also matter. Very often the rest matter because VCs learn a lot about founders, and they, in fact, can invest in those founders again, and those founders will bring them home runs, just maybe not on the current investments. But to identify those home runs is absolutely critical. And by the way, what is really interesting is that when we look at later stage VCs that were traditionally more conservative, less risky, or even growth equity, private equity funds, more and more we see that power law, that the best and the rest principles plays more and more. Now, in private equity firms, you don't want losses. You will not be able to survive 75% of losses because your home runs are not 100 or 1000x. But you're more likely, you're more willing to take risks because you understand that in this environment of uncertainty, and more industries undergo that uncertainty, the best winners will take most of the returns. So as a result of this, in growth equity or private equity, okay, we will not see 1000x, but I think we are more likely to see 10 to 20x than ever before.
As you mentioned, there will be failures in the portfolio companies, and you have to invest good companies and find good startups. How do VCs handle fear of missing out in the venture capital world, which means there are lots of deals coming and you are saying 100 times no to the deals and selecting one? What is the winner's curse?
Well, first of all, you have to realize that because you say no so many times, it's inevitable that you are going to miss some great deals. That is just inevitable. The big challenge is not to miss all the great deals. Okay, that's going to be pretty bad. Now, a specific method that the smartest VCs use, and it's very easy for me to describe it briefly, but in fact, to implement it, you really have to be very smart about it. And again, when I work with large venture capital funds, we spend quite a bit of time thinking about how to implement this exactly. And this method is called anti-portfolio, which means the following. You look at all the portfolio companies that you invested in. You look at all the companies that entered your deal funnel and you said no to at various stages. Or maybe you couldn't get in. There is another possibility, okay? For this, you need to have records. And then you look at the performance of your anti-portfolio. And if those are private companies, so you really don't know how your exactly anti-portfolio performed. But if you miss Google or Zoom, you kind of know how well it performed. Now, if it turns out that first, your anti-portfolio performed better than your portfolio, that's a pretty good sign that, you have to step back and think, okay, and make some changes. Second, if you invested, let's say, in 2 unicorns, which is great out of your fund, but you missed 7 unicorns, even though they're still great returns only on paper. Also, there is, I think it's important to step back and think. And again, as I mentioned, there are deep ways to analyze your anti-portfolio, not just to show that, you're great or you're not great, but more importantly, at which stage of your deal funnel or what specific elements of your decision-making process to change. But again, I'm a firm believer that small changes in how you make decisions or small changes in the structure of your firm arrangements in various ways can have a tremendously large impact on the outcome eventually.
How does these VCs find these unicorns or successful startups? What does their process look like?
Well, first of all, you get outside the 4 walls, which means that, you go out and try to meet as many founders as possible. That's one. It's a business where ideas typically don't come to you. Now, if you're maybe the most famous brand in the world, then the ideas come to you, but even those VCs spend most of the time outside their office. Second, you prepare your mind, which is you spend a lot of time thinking through, meeting with founders, meeting with experts, trying to develop an investment thesis, which in fact, an investment thesis is how the future is going to look like. Okay? And then the third that I already mentioned earlier is about pattern recognition, which is you will have to make decisions very, very quickly, sometimes, very quickly, whether not to invest, whether to invest. And as a result of this, pattern recognition is going to be very helpful. And finally, fourth, I think that VCs that have advisors, their partners, some of their former entrepreneurs, some of their close advisors who understand the market, who understand the psychology, understand the financial stuff, could be very helpful because you need to have a mirror. It also applies to founders. You need to have a mirror that you look into this mirror, and the mirror will tell you back what the mirror thinks about your actions, about your thought process. So I think those are all the ingredients about how you increase the chance of hitting that home run and invest in unicorns.
How do investors typically reject startups? So for the founders, is following up after being rejected with updates or sending newsletter about the progress, is the good strategy for founders? What kind of updates and progress should founders include in their follow-up to make it more effective?
I would say there are two types of VCs. The first type, they reject quite quickly. And again, if it's a fast lane, they'll just say no. And maybe they briefly explain, this is not our investment thesis, whatever. The second type of VC is, they never apply. And well, founders do not like this type of VCs, but they're out there. And one of the reasons why they don't want to say no is because they never know what's going to happen with these founders. They prefer to wait. So maybe Burak is going to invest in that founder, and then, I'll jump back in. Okay. In terms of founders, here's something that I think is critically important. If at any point in time the investor will say no, unless the no is specifically qualified, such as, this is Burak, this is a great idea, but you're too early. Come back to us when you hit 10 million ARR. Unless this no is qualified, once the door is closed, it's very difficult for founders to get into this door again. There are exceptions, there are cases like this, but on average it is difficult. So therefore, you need to minimize the chance that the door is going to get closed very quickly. As a result of this, like VCs, I firmly believe that founders must be prepared. And also, VCs get easily distracted. That is the reality, because they deal at the same time maybe with dozens, if not more, founders. As a result of that, Burak, if, let's say I'm a VC and you're a founder, and you sent me, we'll get introduced to Fair, you pitched me for 30 seconds. I said, that's cool. Send me a pitch deck or send me whatever. You sent me, okay? I looked and I thought, hey, it's interesting. And I sent you back 5 questions, and you took 5 days to answer. That likely, in these 5 days, I forgot about your existence. Likely. Unless I'm so excited, of course, I will follow up myself. I just forgot about your existence, okay? So founders, you should be prepared, because Burak didn't reply in 5 days, maybe not because he was lazy, okay? But because he didn't know how to reply. Maybe ask questions that Burak said, oh gosh, I need to find out. I need to consult somebody. I need to do this and that due diligence, that market research or whatever. Build a financial model. Be prepared. The good strategy is whenever a VC is asking you a question, you should reply within like 1 hour, and not just reply, hi, thanks for asking me. I'll answer in a week. But reply. And of course, you can do it only if you are prepared. So founders have the prepared mind.
What are some common mistakes founders make when trying to apply VCs? Or is it warm introduction or a cold introduction works as well?
Yeah, well, there are a lot of mistakes. The one mistake is sending very long emails. Okay, nobody's reading long emails these days. Second, I think the second biggest mistake is when you contact the VC for the first time, you should not try to convince them to invest in you. Smart VCs, unless they already know a lot about you, they never decide to invest kind of right away, unless, again, they see pattern recognition right away, okay? Rather, they will decide whether to engage with you or not. So founders, you have to increase the chance that the VCs will engage with you. So you need to kind of hook them so that, they're intrigued. Warm introductions, of course, are better. There is no doubt about this. However, I would think carefully about who is introducing you. Because if somebody who is introducing you has a bad reputation, like introducing some bad founders or whatever, then maybe, in fact, it's negative rather than positive. But overall, warm introductions, of course, are positive. Having said that, my research clearly showed, and we give this beautiful example in the book of controversial but very effective research that I've done, in which we sent thousands and thousands of emails, kind of pitch cold emails to actual real investors from fake founders of fake startups. So by definition, those founders don't have warm introduction, they didn't exist. And we had a very high success rate. Up to 15%, 1 out of 6 VCs replied. And in fact, most successful VCs were more likely to reply and positively reply. Like, let's meet. Can you send me a pitch deck? Can you do this and that? Obviously, we spent a lot of time preparing those blurbs, answering the basic questions: why it's me, why the market is potentially large, and the emails were short, like 2 paragraphs apart from the introductory and concluding stuff. So therefore, cold calls work as well. If you're outside a great social network as a founder, don't despair.
How can founders identify the toxic investors? What questions should they ask, and what should they look in the meeting and communication to understand if an investor might be a negative?
Barak, I'm really glad that you asked this question. The reason behind this is that I think founders don't spend enough time to do the due diligence on VCs. Everybody thinks, oh, VCs, their job is to do due diligence on founders. The reality is that it is founders' job to do the due diligence on investors as well, especially those investors who are lead investors, and therefore they are going to join the board, who are going to have an influence over the future of the company. Now, here is the reality, Barak, is that I observed many startup boards, and there's nothing that could be worse than a dysfunctional board. Okay? That just reduces the probability that the startup is going to be successful. And there are many ways that dysfunctional boards can demonstrate themselves, but one is, of course, dysfunctionality of a venture capitalist. Now, therefore, my suggestion is that, it's very difficult to find out who is dysfunctional and who is functional when you just meet a person. And of course, that person is doing the due diligence on you, but also trying to sell themselves to you. But do the due diligence on them. And the very first step is maybe not in the fast lane, but when you move to the slow lane. So effectively, VCs are, let's say, give you a term sheet, let's say, find out their investments, find out the boards that they sat on, approach other board members, approach founders, ask those VCs for whom they would like you to talk to. And, if you ask Burak, me, I'm an investor, I gave you a term sheet and say, Ilya, I'd like to talk to 3 founders that you backed. And I kind of evade giving you their numbers, their names, or whatever. That's a bad sign. This is a bad sign, okay? So I think that is what the founders should do. Frankly, I'm amazed. I've done some kind of informal survey. There's really no academic research on this. I've done some informal survey of founders, and I found out that in more than half of the cases, founders don't do this type of research on VCs.
Do you also invest in as an angel or an LP to funds and startups?
I do. I invest in my former students because I'm doing a lot of research on this industry. I, of course, know a lot of GPs, so VCs, a lot of investors, a lot of founders. I prefer to stay away from investing generically to avoid conflicts of interest, but I invest in my former students. And luckily, many of my former students became founders of VC-backed companies, and many of my former students became VCs and private equity fund managers in their own right.
How do you select them? Do you have a bias?
Well, I have a great bias, which is they have to be my students. Because they have to be my students, and they have to be able to show that they raised money from other credible investors. And of course, they need to show bias too, so that they're willing to take money from their former professor. That's kind of an important component, I think. But I don't consider myself as a venture capitalist who is doing due diligence on all the students. I'm kind of free riding on my knowledge of students because I spend a lot of time with my students at Stanford. I meet with them one-on-one. I correspond with many of them after they graduate. And of course, I observe how other investors look at them as well, if they're founders, or how other investors look at them with their fund managers, which obviously informs my decision-making.
How do you decide to double down or quit? What is your questions or signs when to double down?
So I think that is a very important question. And it's less about me because I'm an individual investor. It's more about venture capitalists. I, in fact, firmly believe, based on evidence I've seen and some research I've done, is that this follow-on decision is quite a critical decision. It's really make or break for many VCs. And that is a simple reason because, you invest in small startups and then some startups grow dramatically. And as a result of this, if you would like to keep your ownership the same, you have to invest much larger amounts. So in fact, a much larger fraction of your funds might go to a specific company. And if you make a mistake, at that point in time, it's much costlier now. So as a result of this double down or follow-on decisions are important. There is something else which I think, Burak, is critically important. If you make, Burak, an investment and this investment is not going well, so you invested $2 million in a startup and 12 months later, there's nothing to show. And that startup is running out of money and raising another round and is having difficulty raising another round, okay? But you're on the board or founders pretty well. They're hardworking, honest, ethical people. They're just maybe unlucky. Maybe, the market is not there. Maybe the product did not work out, whatever. So what do you do? And that is tough because you have a psychological commitment to them. You like the team. I think too many VCs decide to follow on. And it's very often a natural decision. Unfortunately, very often it leads to throwing good money after bad money, as we say. Psychologists call it the escalation of commitment. And I think that is one of the most underappreciated biases in the venture world, but also way, 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 way beyond. And so I already mentioned earlier that the way you make follow-on decisions and the way you make initial decisions is different. And one critical difference is that in the follow-on decisions, you have to somehow, and that's difficult, get rid of your initial bias. And your initial bias, Burak, is because you invested in me, okay, a year ago. You're just more likely to follow on, no matter what, especially in the world of startups, because, it's very uncertain. The miracles are always possible. It's always possible to justify you spending another $5 million on me. Now, here's something to think about. When you spend more money, it is not just the money. It's also your time, because you tend to spend more time with startups that are underperforming. And also, of course, it's less money for other startups. So as a result of this, and again, I believe that if you're a venture firm, you have to step back and think about your follow-on process. But if venture capitalists listen to us, my advice to them is very simple. Look at all your follow-on decisions, which means that if a startup that you invested in was raised another round, and ask yourself, just get statistics in how many you invested. And it turns out that you invested in 90% plus of all the follow-on opportunities. That's likely not very effective, not very efficient. So you would like to reconsider this. Again, I've been working with a number of venture funds on this. So you would like to reconsider this likely.
We are living in a quick results demands, often quick results and impatient world. How do you convince especially LPs and other stakeholders to get great things take time mindset?
Burak, this is absolutely essential question because especially in the world of startups, results take time. And this is a big problem, for example, for corporate venture funds, where your chief finance officer of a mothership, so to say, tells you, so Burak, you're managing my corporate venture fund on behalf of my large company, and I'm your CFO, and I will say, Burak, I'm really excited about all this startup. So by the way, you invested 6 months ago, right? So what is the result? Well, there is no result unless the startup already failed. So I think that it in fact starts with education and understanding of what is known as the J curve and what is known as that your lemons ripen much faster than your peaches. It's easier said than done. In my experience, many large investors, especially within corporations, do not fully appreciate that. Now, I think that every single smart VC understands this. And the question is, what kind of your investors will understand it or not? Now, in some cases, I think VCs that they can afford to, they will not take money from those who have a very short horizon. Again, if you're in a corporate venture, you are not able to very often select your LP. So that's, I think, a challenge. From the founder point of view, I do think that you would like, before you take money from that investor, to ask yourself, are they with you for a long time? Or do they want results very quickly? Or are they investing their last money? And there will be no more money, okay, for your follow-on investment. Burak, you're smiling, but I've seen that. I've seen that. It happens very often with angel investors, but in fact, it does happen with VCs and CVCs. So as a founder, you have to ask yourself this question. Let me give you my final statistics number. When we look at all the American unicorns, okay, it takes 7.5 rounds of venture funding, and it takes 8+ years from founding, 5+ years from the first venture round to become successful. So you need to be, on average, very patient. When I say on average, some of them takes 10+, 15+ years. And these days, it takes longer. So therefore, unless you believe, or you can convince your investors to believe that great things take time, then you should really get out of this business.
Thank you very much, Ilya, joining me today. It has been a pleasure having you here, and also appreciate your time and insights.
Thank you, Burak. And let me say finally that I'm extremely excited to share the venture mindset and my learnings from the 20 years of trying to understand this space and innovation, not just with American audience, not just those who come to Stanford to be my students, but especially in the world of Turkey, Central Asia, Asia, and beyond. Because I think that the venture mindset is really applicable everywhere. And in fact, I think that if anything, it's even more applicable in many emerging markets. Because I believe that there will be, in the next 10 to 15 years, there will be many emerging innovation hubs in those markets around the globe, Turkey including, but not only. And as a result of this, those who are going to use the venture mindset, effectively, whether you're the founder, whether you're the venture capitalist, whether you're the angel investor, the regulator, corporate venture investor, or large company, I think you will be able to make inroads and benefit from a lot of opportunities that the future will bring. So thank you so much.